Hello to all those who have joined so far. We're going to wait a few more minutes and let others join, and we'll get going here right around 10 o'clock. Thank you. Hello, all. Thank you again for joining. We'll give it about 60 more seconds and allow others to join, and then we'll be off and running. Thank you. Good morning. It is 10:01, so we're going to get going here. Want to make sure we're uh, respecting everyone's time and hope you're having a great Wednesday. Welcome to the Traction Financial Partners Market and Economic Recap. I'm Evan Barnes, co-founder and chief investment officer. This is
I'm here with Evan today, Bob Haycoop, CEO.
awesome. So every quarter we do these the market economic recaps. This will be recorded, and throughout the presentation here, if you have questions, go ahead and type those in to the question box at the top, and we can get to those at the end of the webinar. So if something comes up along the way, make sure you're typing those questions in. But we're going to go ahead and get going here. Today's agenda, we will be covering the year-to-date equity market returns, going through how the stock market's doing, different sectors of the stock market, how those are performing, and a little bit of context about where the returns have come from this year. We'll also speak about commodity markets and how those have done so far this year. Fixed income and interest rates. How are bonds doing? What's going on with the Federal Reserve? Those types of issues. Bob will be going into that, as well as markets in perspective, which we have some really interesting information there, and discussing, volatility of the markets this year, investing at different times in terms of entering the markets at all-time highs. Also, a slide on the election and historical performances around that. So let's dive on in and talk about the equity markets overview for 2024 so far. And it's been a strong year in the markets. So on the screen now, you should see this is the equity market returns through July 19th, so very current. And under the year-to-date column, so the second one in, you can see that so far this year, the Dow Jones Industrial Average, so the 30 largest stocks in the market, up just over 8% year-to-date. The S&P 500 up at 16.3 And the S&P 500, historically is something that we look at very closely in terms of how the overall market is being represented. And we'll dive in a little bit further into the S&P 500 here in a second and where the returns are coming from. But again, halfway through the year, a little bit more than halfway through the year, a strong start on the S&P. The NASDAQ, which is going to be more of your growth type stocks and technology stocks at up 16.5%. And then we have some additional indexes in here that we track internally as an investment committee. And we look at the differences between growth type stocks and value type stocks. Growth being, again, more the tech side of things. Value would be financials, banks, insurance companies, utilities, those types of stocks. So as you kind of go down here, the S&P 500 growth versus value, year-to-date growth up almost 23%, value up almost 9%. It's at 8.85%. This has been a theme the last few years, is that growth type companies have outperformed value type stocks. Over time, they do rotate in terms of who tends to outperform, but we are in a cycle here the last few years of where growth has definitely outperformed value stocks. And as we get into the middle portion of this slide here, we're looking at S&P mid cap, so mid-sized stocks, and then S&P small cap, so small cap stocks, and it breaks it down between the S&P 400 growth and value, small cap 600 growth and value. And you can see the same thing where the mid-sized stocks on the growth side is better than the value side. It's the same thing with the small cap stocks. Russell 2000 is a broad-based index that looks at mid and small size stocks, up 8.5% this year. If we did this presentation a couple of weeks ago, that index was basically flat. We've seen a real nice bump the last few weeks when it comes to small and mid-sized stocks in that Russell 2000 area. Right below that, MSCI EAFE, Europe, Australasia, and Far East. So that's talking about the developed countries across the globe. So we look at international stocks up almost 7.5%. And then one more I'd point out at the bottom is the S&P GSCI. We're going to talk more about commodities here in a second, but commodity returns is what that index is for. And commodities being energy prices, precious metals, agriculture, costs for corn and wheat and those types of things. Those types of returns have come in as an index at 7.84%. So those are the year-to-date returns. One thing I always like to look at when we're looking at this slide here, looking at the indexes, is the far right column, the 5-year return. Okay, so it's important to add some context around looking a little bit further out than just what we're doing year-to-date or over the last 12 months, but bringing in the last 5 years. You have COVID in there. You also have 2022, where we saw a bear market, more than a 20% drop in the S&P 500. So despite that type of volatility happening, you can see some really nice returns over the last 5 years, the S&P 500 averaging almost 15% a year. So again, we like when the slide looks like this and we see some positive returns across the board here. We're going to go to the next slide, which is 2024 year-to-date sector and style returns. Okay, we won't spend a ton of time on the left side. On the left side of the screen, you're looking at our style box. And we just discussed this on the last slide, but the differences between large cap, mid cap, and small cap down the left axis there, L, M, and S, and then how they intersect with value, blend, and growth. And you can see the best performer in the upper right-hand corner, the large growth stocks. Okay, a lot of the big tech guys, which we're going to talk about here in a second, those have been the best performers this year. And small value, the bottom left would be the lowest performer at 7.1%. Again, great news is everything is up, but we are definitely seeing the growth side of the market outperform, and we've seen that here for a few years. But on the sector part of this, when you look on the right-hand side there, the bar chart, the nice thing is that everything's positive again, but you can see that when you look at the different sectors of the S&P 500, technology, communication services, financials, utilities, energy, so on and so forth, that technology up 27% this year is leading the way. And the lowest performer, excuse me, for the year so far is real estate. Bob is going to get into interest rates, mortgages, those types of things, and it makes a lot of sense why real estate has been lagging with higher interest rates and higher mortgage rates so far for 2024. But that sector was negative for most of the year. Inflation reading has come in a little bit softer over the last few months. And because of that, there's some hope that the Federal Reserve might cut some interest rates sometime this year, meaning that real estate could get a bump off of that. But as you can see across the board here, that for the most part, we've seen really nice returns. And we'll jump forward to the next slide. In our last webinar, we discussed the Magnificent Seven. Okay, the Magnificent Seven has gotten a lot of press over the last year. A lot of names that we're familiar with, and rightfully so. They've been discussed as been the key drivers in the market. So the mega cap tech stocks is really what has helped drive the market over the last few years, and these 7 stocks in particular. So Microsoft, Nvidia, Apple, Alphabet, which is Google, Amazon, Meta, which is Facebook, and Tesla. And if you look at the bar charts up top, you can see what each of those individual stocks, what their weight was in terms of how big they are as a percentage of the S&P 500. So 500's largest stocks in the U.S. market. These 7 stocks, you can see what their weight was in 2014, 2019, and so far year to date. So for example, Microsoft made up 2.1% of the S&P 500 in 2014. That grew to 4.5% in 2019. And currently Microsoft makes up about 7.2% of the S&P 500, which is the biggest holding. Okay. And you can see each individual stock and how it's done. But look on the far right-hand corner, upper right-hand corner, when you look at these 7 combined, and how large they are, how much they move the market, you can see that in 2014, the Magnificent Seven made up 8.9% of the S&P 500 weight. That grew to 17.3% in 2019. And right now, we're looking at about 32.3% in terms of the weight of these 7 stocks. So 500 stocks, a third of that index in terms of the size of the stocks is made up of these 7. So when they move, the market's moving. Okay, that's something that we're watching very closely, because when they move in the right direction, that's great. But there's an example here I'll show you in a second that to be so concentrated can also add some volatility. And in the chart here at the bottom, you can see in 2019, 2020, 21, and so on and so forth, the returns of each of those stocks individually and how they ranked in terms of their returns by the end of that year. So if we look, for example, let's pick 2019. In 2019, Microsoft did 57% return. Okay, that was the 48th best stock in the S&P 500. All right, and you can see some really nice returns across the board for basically all those stocks. The S&P did 31% that year, and a lot of it was driven by these guys. Let's fast forward to 2023. So let's look at last year. You can see Microsoft did 58%. Nvidia, which is a large semiconductor firm, they use a lot of make a lot of the chips that go into our phones and our cars, and now they're really big into artificial intelligence, which I'm going to talk about here more in a second. Last year, Nvidia did 241%. That was the number 1 stock in the S&P. Meta, which is the second one from the bottom, did 194. That was the second best stock in the S&P 500. And Tesla right below that was 8th best stock. So you can see when they move the market, in a positive direction, you can have really nice returns on the S&P 500. Go back though real quick to 2022. Remember, we had a bear market in 2022. A bear market is when the S&P 500 drops more than 20%. And when that happened, the market ended down 18 that year, but at one point, I believe we were down closer to 24% down. And you can see in 2022, the returns on each of these stocks. And let's take Tesla at the bottom there. Tesla was down 65% that year. That ranked 500 out of 500 stocks as the worst performer in the index. Meta, right above it, was down 64%. It was the 498th best stock that year, so only two stocks worse. So as we look at how large these guys have gotten, whether they move really well in the positive direction or poorly in the negative direction, it moves the market. Diversification helps take some of this risk off the table, and that's why we believe internally as an investment committee that diversification is key. Okay, to one, you can get a little extra bang for your buck depending on what's going on in the market and where you're allocating your assets. But just diversifying some risk off the table is important, because if you're just concentrated, let's say in these 7 stocks, in a great year, that's awesome, but in a bad year, that doesn't work out so well. All right, I discussed NVIDIA, and NVIDIA has been the best performing stock for the last 2 years, and a big portion of that has come from the fact that they are getting into artificial intelligence, or AI, very aggressively. And they're not the only ones. A lot of folks are going towards implementation and using artificial intelligence. I know that some of us may not be as comfortable with AI and how that might impact the economy, how it might be used, whatever that might be. It's uncomfortable and definitely something that we're going to have to get used to, because it is not going away. A lot of money is being pushed into the AI space, and that's what this slide is showing. And on the left-hand side of the bar chart, the capital expenditure for major AI hyperscalers, which is basically the large-scale data centers that are being built for artificial intelligence. Okay, and so you can see how much money was being put into this area of the economy going back to 2004, and what we're projected to be spent in 2024. Look how much money capital expenditures are going towards AI. Okay, and if you look in the bottom right-hand corner, I really like this, the AI adopters. Okay, so when you think of artificial intelligence, you think of technology. And rightfully so. But there's different parts of the economy that are really starting to pick up and use artificial intelligence. You can see on the bar chart in the bottom right-hand corner, information. Okay, that's going to be the technology side of things. Professional, technical, education services, real estate, finance, and insurance, entertainment, recreation, healthcare solutions. You can see currently the adoption of artificial intelligence in each of these different sectors and kind of where it's going over the next 6 months. It doesn't have to be just in the tech world anymore. We're seeing AI go across all these different parts of the economy, and it's going to be a big factor going forward in terms of economic growth and productivity. In the upper right-hand corner, a big factor that's going to play into the usage of AI and how it's going to impact us is going to be how much energy demand there is. Global energy demand from data centers and also cryptocurrencies uses a lot of energy. You can see in 2022 the terawatt hours for data centers and cryptocurrencies, and where it's projected to go in 2026. That estimates 1.8 times as much. A lot of energy usage, a lot of electricity demand for artificial intelligence and cryptocurrency, and that's not slowing down. So where's that energy coming from? What's the most efficient and best way to make sure that we can support the data centers that are being used for artificial intelligence? That's all part of the conversation and stuff that we're watching and researching very closely, is how do we understand where capital is going to be flowing when it comes to energy for this type of demand. All right, to piggyback on what we just talked about for AI and the economy, productivity on the left-hand side talking about the average U.S. productivity growth. You can see from 1930 through 2000, the productivity growth in the U.S. 2.04%, and what it's been the last 20 years from 2000 to 2019. Productivity in the U.S. has dropped. Okay, some of that is that older generations are retiring. We have baby boomers that are winding down. So the question is, how do you fill that gap and make the U.S. economy more productive, more efficient, more streamlined? AI is going to be a big part of that. Okay, and so when we look at the amount of money that's being put into software and research and development on the right-hand side, and how that's going to generate GDP growth in the economy, that type of investment is going up, and you can see on the chart there that's going to continue to go up. And so again, it's not something that I'm just endorsing or promoting. This is the economy that we're going to be getting into, that we've already started to use and utilize, and that's only going to grow from here, is using AI and the economy. Our job is to understand what's the best place to allocate assets for you as part of your portfolio to take advantage of stuff like this while still maintaining your investment objective and risk tolerance. These are things internally that we're looking at. All right, I'll wrap up just looking at commodities and why it's important that we've been looking at the commodity prices the last few years is because inflation, which really picked up in 2022, right? We got over 9% inflation in the summertime of 2022, which led to the Federal Reserve increasing interest rates the way they did. And inflation can be driven a lot by commodity prices. Okay, so when we look at these different prices in here, oil, right? So a year ago, July 12th, 2023, oil was at $75.77 a barrel. That has gone up over the last year. We're at 82.62. Okay, so the price of oil has gone up. One nice thing is that the price of the pump has not. It's basically flat, maybe a little bit down even when you look at gasoline prices at $3.55 a year ago to basically $3.50 now. So that's another thing. Again, from an inflationary perspective, the cost of energy and how that's passed on to different parts of the economy is a big thing to look at when we're looking at inflation and what the Fed's going to do with interest rates. Natural gas has dropped. Gold is basically at an all-time high. Gold has really picked up over the last year, went from 1953 to 2407. Silver also up quite a bit, and same thing with copper. Corn, so we look more at the food prices, has dropped. Corn from 563 down to 405. Okay, the commodity index, when you put all this together at the bottom there, the commodity index is up slightly, and a lot of that's going to be the precious metals and some of it being oil. But the commodity index up from 231 to 230, excuse me, to 238. And so again, we watch this very closely because how is this going to impact inflation, which then impacts the Federal Reserve's decisions with interest rates, which is watched very closely by the stock market. That does it for my portion. I'm going to pass it over to Mr. Haycoop now to talk about fixed income and interest rates and talk more about the bond side of things.
Great. Thank you, Evan. Also wanted to thank our entire team for their relentless pursuit of excellence in everything that we do, and putting together these webinars for all of you to benefit from. So just thank you. As we look at what's going on with interest rates, those of you that have been in the housing market here in the last year have felt the pain of the increased interest rates. It's fascinating as we look back even over the last 3 years, the US aggregate bond rate still is negative. It's almost negative 8%, as are US corporates. We've seen a little bit of a change here just in recent weeks, but we're still looking at negatives over the last 3 years in every area except our high yield bonds, which have been giving us about 5.5% a year. This is, and Evan mentioned it earlier, and this is one of the most important reasons for diversification and why we utilize alternatives in our portfolios, including the excuse me, including the structured notes that have outperformed the U.S. Aggregate bond rate for close to 5 years now. And this is one way that we're able to give our clients that hold these in their portfolios some extra yield. As we look at what's going on with current rates, the treasuries have all in the last few weeks come down from their highs at the end of June. The 2-year is paying 4.45, the 10-year 4.18, and the 30-year 4.39. So not a whole lot of spread difference between short-term and long-term treasuries, but we have seen those start to come back down. If we think about, and Evan mentioned it earlier about real estate has been performing negatively in the markets here lately. Rates going from 3% mortgage just 3 years ago up to 7% has really negatively impacted the activity we're seeing in home building, the activity we're seeing in people that have decided to stay put where they're at and keep their 3% mortgage, or certainly if their home is paid off, not paying any interest to jumping up to 7%, has slowed that part of our economy down. Prime rate is just unbelievable that it's gone in 3 years from 3.25% to 8.5%. And many homeowners and businesses that have borrowed money using the prime rate, that has more than doubled their interest payments. So it's critical that as we look at our portfolios on a monthly basis, that we're taking into account what's happening with rates. We all remember back in the day where you could barely get a CD paying 1% if you tied up your money for 3 to 5 years. And now CDs and money markets have been ranging from 4.5% to 5.5% over the past year. All right. There we go. Thank you, Evan. We all hear on the news on a regular basis the federal funds rate and what are they going to do? Just thinking back in the past year, as we started 2024, the market was expecting at least 2 cuts, as we can see on this chart right here, coming into 2024. So far, we've had no cuts. Currently, the Fed is estimating they're going to make 1 cut. The market is still pricing out 2 cuts before the end of the year. And that also raises the question of why now? Why are they cutting rates now? And with the upcoming election, some speculate that that might be politically motivated. Some speculate that that is what the Fed has been planning all along since the beginning of the year. Long term, the market is still thinking the rates are going to drop down in the high 3s, which certainly would help the prime rate and 30-year mortgage, but it's also going to reduce what our treasuries are paying, as well as some of our bonds, which we'll go into here in a minute. Interesting slide here. If we just go back 4 years to June of 2020, and we look at what would happen if rates don't change if rates rise or if rates fall, the range that we would expect to see in performance in bonds back in 2020 could have been as negative as almost 5% or positive as much as 7%. And that depends on whether they raised rates, which is indicated by blue, or they lowered rates indicated by red. Fast forward to this year, that range has stayed about the same as far as the range, but we've gone from a -1 if rates rise to a +11 total return on bonds if rates were to fall. On the far right side there, you'll see what a 1% reduction in rates would possibly do over 1 year. Rates fall 1%, the yield would be 5, but the price return or the value, underlying value of those bonds would go up to 6%, giving us a total 1-year return of 11%. If things don't change, stay where they're at, we can expect about a 5% yield coming off of bonds with no return from appreciation or losses. If rates drop by 1%, which many are thinking, if rates rise by 1%, what many are thinking, if that happens, we're going to see a 1-year return in the negative. So keep your eyes open for what decisions the Fed makes at their upcoming meetings, and how that's going to impact your savings as well as your borrowing. All right, to keep this in perspective, I don't think there's anybody on the face of the earth that hasn't watched what's unfolded in this country in the last 11 days with the attempted assassination, as well as the president stepping down from the upcoming presidential race. I don't think at any time in our history something like that has ever occurred. Having said that, we would expect some significant volatility in the markets, but look at what's happened just so far this year. We have hit an all-time high 135 times. I'm sorry. Let me look here. 32 times, right? Oh yeah, sorry. I'm looking the wrong part of the slide. 31 new highs this past year. The average of all-time highs since 2020 has been 135, and the long-term average for the S&P 500 is 25 times a year. So we've hit an all-time high already 31 times, exceeding that average. When we look at what we can expect coming out of the S&P 500 over the next 1 year, 3 year, 5 years, is 69% of the time we'll have positive results when we've seen the S&P hit those all-time highs. In the next year, 31% of the time we've seen negative results. In the 3 year, 86% of the time. So looking out for the next 3 years, we expect to see, and historically have seen, positive returns 86% of the time, 14% negative returns. And then over the next 5 years, if we're looking at the averages, 82% of the time we expect positive results in the S&P 500. So again, that's good news if we're looking at history, but as we're all quite aware, things can change quickly, and volatility is on everybody's mind. So where is our volatility? We have, in recent years, the lowest volatility compared to our 25-year average, which is 72 days where the S&P has moved either up or down 1% or greater. This year, It's been only 20 days that we've seen that to date. The last time we saw volatility this low was back in 2017, where only 8 times did the market move more than 1%, which was a very benign, boring year if you were watching your investments on a daily basis. Thinking ahead, what happens and what does that mean? Well, in the next few months, if you look at the bottom of this slide, the year-to-date return in 2024 is 15.3%. In 2023, we had 65 days of 1% moves, and we ended up with a 26.3% return. And so far, we're tracking to have that or better, barring any unforeseen events or circumstances in the markets and decisions coming out of the Fed. Question we frequently get: how does the market perform under a Democrat president or a Republican president? If you look at the blue line and had $1 million invested back starting in 1950, your $1 million between then and now would only have grown to 3.12 million. If you invested only when we had Democratic presidents, if you invested when we had only Republican presidents, you're almost flat. Your $1 million would have just returned a slightly more than that over the last 70 years. Now, if you stay invested, and that's always our advice and our encouragement, regardless of the balance of power we're seeing in Washington or even locally, that $1 million would have returned $32.55 million, which I think all of us would appreciate that. So a little bit of perspective on politics as we're going into an election here in less than 3 months. And I wanted to share this with you. Evan shared this with me the other day. For Xander Schauffele, who won the Open, best golfer in the world at this time. The key, if you've listened to his post-Open win interview, the key was trusting the advice he got. His father's been his coach for many years, and his dad encouraged him to hire a swing coach, one of the best in the world, and his name is Como. And just by making some slight changes, he went from being a top 10 ranked golfer to winning 2 majors in 1 year. And you can see the smile on his face there because he finished the Open, and as he would say it, with complete peace. I was calm, I wasn't nervous, and I felt confidence because I was trusting the advice. That's what we continue to encourage all of you to do, is trust the advice in our team, which I was looking at last week. And between all of us, we have over 100 years of combined experience in financial planning and asset management. Want to end this and open it up to any questions that any of you may have. And thank you for taking your time and spending a little bit of time this morning with us.
So thank you, Bob. Let's see in the chat box. I don't see any questions at the moment. Let's we'll just pause here and see if anything comes in. While we're doing that, we're gonna read this to you. Just just joking. We're with the disclosures for the recording here. See if it's come in. Again, no questions so far. We'll give it another 60 seconds here and see if anything comes in. We appreciate you joining us today. This is being recorded. If you missed part of it, you want to send it to someone, please do so. That would be awesome. We appreciate that, you guys join us, but if there's anybody you think would benefit from seeing this, then please do send that on. We do post these to our website, as well as some other ones from the past. So go ahead and jump over there at tractionfp.com. We do have one question. Historically, markets have declined after the Fed cuts rates. Can you explain why that may occur? That's a good question. I guess it does depend upon the reason that they were cutting rates. Typically, the reason that they cut interest rates is going to be because the economy is slowing down, right? So I think part of the reason we saw such a large estimate of what the Federal Reserve was going to do with cuts this year coming into 2024 was the fact that they thought the economy is slowing down. If the economy is slowing down, does that mean we slow down into recession time period? And if you go into recession, obviously earnings and economic activity has dropped. Thus, you might see the markets decline during that period of time. So that typically, I think, would be the answer there, that if the Fed's cutting rates, a lot of times it's going to be because economic activity has slowed to a point that they think that they need to fuel the economy with lower interest rates that would hopefully keep you out of a recession, that type of a thing. The Fed is targeting a inflation rate of 2%. Hasn't gotten there yet. We've been pleasantly surprised that the Fed has kind of held their to their stated mission of trying to get inflation to 2 before they have done any cuts. And again, I think that if we see them cut, you want to make sure we're looking at economic activity at that point and seeing kind of some context to it. Is that because the economy is getting so bad that they have to cut? Or is it because they've accomplished more of that soft landing that they were shooting for? Time will tell. We have seen some economic reports come in the last couple of weeks that has shown that we are slowing down. So that's something that internally, as an investment committee, we're tracking on a weekly basis. When we get together for our meetings, we're discussing all the economic data and seeing how that might impact what the Fed's going to do. So that's a good segue into, we are going to do a webinar in September around our investment committee. How do we make decisions? How do we build portfolios? What's our philosophy? How do we choose the funds that are in your models? All that stuff, I think, is good for us to pull the curtain back on, so that we can show you guys, how we come to the decisions we come to, what our philosophy is, those types of things. So please join us for that one. I think that one's going to be really, really important and interesting. So I think that we haven't had a date firm yet, or do we? No, not just yet. We'll be sending out emails to firm up that date, but that will be in September. All right, I think that is going to do it. It's the only question that came in. We appreciate everything that you do for us and for joining, and we'll let you get about your Wednesday. Thanks a lot.
Thank you.